but they thought they could. And here's how they would do it. They would buy an asset, a bond of some sort. And as soon as they bought it, they would buy another asset that moved in the opposite direction, which a process called hedging, basically buying something that moves the opposite direction. And then they would have computers that monitor those things literally at intervals of less than a second. And anytime any one of them made a move outside certain parameters, they'd buy another asset and hedge that one. And all the time keeping this little sliver of profit in there. And sometimes they'd have up to 70 or 80 assets booked around this one initial transaction, but they always had that little sliver of profit in there, and they thought they were diversifying away all the risk. And they wrote these computer programs, and people got really excited about them, and they sold them to a few companies. You may have heard of some of these companies. It'd be AIG, Bear Stearns, Lehman Brothers, Merrill Lynch. You might they've been in papers a little bit lately, and they all bought one of these things, and they all got a little division set up. They kept doing their main business, but they got a little division set up that messed with this stuff all the time and started doing all this complex financial stuff. And they forgot one tiny detail. If everything goes down, you can't diversify against that. If it all goes down at once, you're going to lose. So you can't really eliminate all risk. And if you have just a tiny bit of profit in there, when it starts going down, you're going to be hurting. And that's kind of the situation they got themselves into. Fast forward a few years past that to 1989, and we passed a bill in this country that was the Financial Institutions Modernization Act. And it was a good bill, and we needed the bill. Basically, prior to that, our banking regulation in large measure went all the way back to the Depression. And obviously during the Depression, we put a lot of restrictions on financial institutions. And basically in this country, a bank could only be a bank, a broker could only be a broker, an investment banker could only be an investment banker, and so forth. So you didn't really have these big institutions that could do everything at once. And that wasn't working. We needed to change it because the world was getting bigger and more complicated. Other countries allowed intermixing of all these things, and consequently we were the biggest economy on earth, but we didn't have any of the 10 biggest financial institutions. And it just wasn't working. And they would try to do partnerships. Brokerage firms would partner with banks and try to do things. And it was just inefficient. It wasn't working. So we needed to change it. But there were a few details that kind of slipped up in this bill. And one of them was, I hear a phone ringing. If that's one of my creditors, I'm in Brownsville, okay? One of the things in particular was these other guys who had just bought these fancy computer programs, and they just started doing all these fancy swaps with them, and they decided, we'll just go ahead and not regulate that at all, too. We'll just let that go any way it goes. And economists love markets. We absolutely love markets. We think markets are great. But markets only do what they do. And what they do is they allocate resources. And that's it. They're the best thing in the world to allocate resources. And the way they do it is they assure that you will follow incentives. So if the incentives are right, man, everything's going to be great. If the incentives are wrong, we're going to run it right off the track. Because if you don't have some kind of sideboards on this thing, it's going to run right off the track if you set up the wrong incentives. Well, these guys suddenly had no regulation on some things that looked like they made a whole lot of money very quickly. They got big bonuses for all that money they were making. Their investors were happy. Their stock prices went up. They got stock options. So we created a system that said, if you keep doing this stuff, it's going to be really good. Well, in a market, if you don't regulate, we're going to keep doing it. And we're going to keep doing it until we drive ourselves down. And so that's kind of what happened. But I don't want to get ahead of myself just yet. I'll talk more about that in a minute. But anyway, that was one kind of watershed moment. A couple of years later, we're now up to 2001, so we're getting to the present pretty quickly here. In 2001, we passed another bill. Again, very good bill. Very good bill. It was called the Fair Credit Reporting Act. And what it basically did was it gave us a uniform way for people to evaluate credit. The most common thing you see is credit scores. Is the most common thing. Everybody knows what a credit score is. And why that was important was, and it was particularly important for this region. And why it was important was because before that, if you came from an occupation group, an income group, an ethnic group, a neighborhood, or whatever the case may be, where historically there had been some credit problems, well, people couldn't look at you individually. They kind of looked at those groups. And it was difficult to ever break through. Like even if you'd paid every payment on time and that sort of thing, it would be hard for you to get a loan to buy a house. Because for you to get a loan to buy a house, a banker would have to sit down and take enough time to get to know you personally and figure out everything about you. Well, in the time they could do that for a $100,000 mortgage, they could do something else for a $10 million deal. And so it was just, just efficiency. It was hard for people to break through. Credit scores took care of that. All of a sudden, if you had a certain income level and a 790 credit score, that said something. And it didn't matter what your income group, your occupational group, or anything else was. The reason that was really important in this area, and the reason you saw such a housing boom in the early part of this decade was one group that this really helped was the military. because individual people could be evaluated on their credit worthiness again, whereas historically that had been a group that some lenders shied away from. Not local ones in this area because you know them, but the big national groups had sometimes shied away. So it's very important. It was a very good bill. And this sentence has a very important clause in it. Once that started, we had a building boom, and it was wonderful because people who could never own a house before, and here's the important clause, comma, but who could afford it and deserve to own it, comma, could own a house, okay? And this was great. It was wonderful. We're building all these houses, and the mortgage companies were making the loans. They were selling them mostly to Fannie Mae and Freddie Mac. They would package them together and turn them into securities. People would buy those securities. Fannie Mae and Freddie Mac would get the money. They'd put it back in the banks to pay them for the loans. The banks had more money to make more loans. It was a wonderful thing. But, you know, politicians can be a little crazy sometimes. And I know this doesn't make sense to you, but they think this way in Washington sometimes. They got to think, you know, this is great. Boy, people love us. They're getting to buy houses. This is great. They all, you know, our constituents like it. They're voting for us. But, you know, this is kind of unfair because we're letting the people who deserve a home get one. But isn't that kind of unfair to the people that don't deserve a home? Shouldn't they get one too? Okay? So you start having an attitude in Washington, Federal Reserve and Congress, you know, saying, you know, let's make some more mortgages. Let's get this thing going. At the same time, the market had something weird going on. Because around 2001, 2002, y'all remember the Enron scandal? All that? And what the Enron, Adelphia, WorldCom, there were a bunch of them. But what it came down to was companies were not reporting things properly on their financial statements. Markets are driven by information. If people don't trust the information, they don't want to invest. And so all of a sudden, everybody was looking for some way to hedge, you know, move away from the stock market. What's something we can buy that'll get us a good return, but we're not vulnerable to all these problems in the stock market? They looked around, there were billions and billions and billions of dollars worth of these new mortgage-backed securities. So they said, hey, let's buy those. And so they start buying those. And the first ones are very good, and they're making about a 7% return. But, you know, these are investors that are used to be in the stock market. They're used to taking a little more risk, and they're used to a little more return. And so at the same time, Congress and the Fed are saying, let's make some more mortgages. These investors are saying, you know, we'd like to have a way we could book a little more than a 7% return on this deal. Y'all got any ideas? And sure, you can book more return. All you got to do is take more risk. And what they would do is they set up these so-called adjustable rate mortgages. And there's nothing wrong with an adjustable rate mortgage in principle, but the way these work, they had a teaser rate. It'd be like 3.5%, 4% for a couple of years. And then it would adjust up to a market rate of 6, 7, 8%. Well, and because some of these people were lower credit risk, it would even adjust up higher than that. Well, people are always looking for bad guys in this thing, and they want to blame Fannie Mae and Freddie Mac and others, and they did some stuff that was bad, but they weren't any of the real bad guys. My first real bad guy in this story is a group called the Office of Thrift Supervision. Y'all ever heard of them? A few people have. Most people haven't. But you probably have heard of something called the FSLIC. Does that sound familiar? We haven't had an FSLIC in 20 years because it was the insurance thing for the savings and loans and regulator. It went bust in the 80s. They moved the insurance part over to the FDIC that works with the banks, but they created a new regulatory group called the Office of Thrift Supervision that was supposed to regulate the people that used to be called savings and loans, thrifts, the people who make mortgages, make most mortgages. Well, obviously, most of them didn't survive the 80s, and so they didn't have a whole lot of them then. And Congress, one thing they did when they created that thing was they didn't fund it. They said, you need to get all your money from the people you regulate. Well, if you're regulating thousands and thousands and thousands of people and nobody provides more than a small fraction of your money, that's fine. But they didn't have many people to regulate. And so they had to go out and recruit people to regulate. Well, how do you recruit somebody to regulate? You don't regulate, okay? And it got to the point, for example, Washington Mutual, who was one of the big players in making these crazy mortgages. Washington Mutual at one time provided 15% of its regulators' budget. So who's regulating whom in that situation? Nationwide, countrywide, they all were providing 5, 6, 7% of the budget. So I mean, just a few institutions were really funding the regulator. At the same time, the guy who was running it really